Hello, my name is Phil Champagne from Run Investment Group, and this is Chad Laird of Southwest Montana Properties that we have here today. Chad has an extensive career in commercial real estate investment. He owns he owns a large number of apartment units, from single-family homes to large properties. And we will be talking about how he got involved in real estate and what he found from it. And so the first question I would like to ask you is tell us how and why you got. So first of all, hello, Chad.
Hello, Phil. Glad to be with you today.
So tell us how you got involved in real estate. How did this all started?
Yeah, so I knew kind of my whole life that real estate was a good idea. It was a good investment. Had some relatives that had investments in real estate, and family friends, and those kinds of things, and could tell that it was a good place to invest, but never really knew a lot about the details or anything involved in real estate investing. What type of hope that it promised for returns, and specifically how to do it, those kinds of things. But my wife's parents have a triplex they've had for many years, and they have a condominium they have had for many years as investments, and they've done very well for them. So when the opportunity came along for my wife Elizabeth and I to purchase the neighbor's house as a part of an estate sale, we jumped at the opportunity, not really knowing exactly what the opportunity was or exactly how it was going to work, but knowing that it would be a way for us to get our feet wet and learn something more about real estate. And that's exactly what we did. We jumped on that opportunity, bought it, did some extensive rehab work on that property, had it as a rental for many years, and ultimately sold it creatively by carrying the carrying the mortgage on that for a family that came along and wanted to buy it. So it turned out to be a great way for us to start to learn the business, and we've never looked back from there, and just have gone on and learned more about it and done more since.
So the financial programs on television are talking about how investment in real estate is risky, and how you could lose everything, but certainly with the 2008 problems that we got lately, they are kind of some sort of an argument in their favor with this. How did that affected personally yourself, and what would you say in regards to that?
Yeah. So this argument obviously has some truth to it. With any investment, there's risk, and there's the ability to lose. However, the way that we invest in real estate, commercial real estate exclusively at this point, is with a focus on cash flow, meaning some healthy profits off the property from each one of the properties over time, as a differential between the income that's coming in on the property and the expenses on the property, as opposed to one of the other primary ways to invest is looking exclusively at gains on the value of an asset over time as the market that it's located in improves. And that's a very risky proposition, because then if the market gets worse, rather than seeing improvement there, you don't see the improvement. You can get hurt on the cash flow side, and then pretty soon be in trouble. So with our focus on strong cash flow and properties where there's opportunity for us to dramatically improve the cash flow by some simple changes that can be made on the property, rather than being entirely dependent on the surrounding market, we put ourselves in a position to be much safer in each one of the investments. And that's exactly what we've seen over the last few years with this contraction in real estate across the country, where actually the last couple years of that contraction has increased our cash flow on a number of properties, as more and more homeowners have had trouble hanging onto their homes, and they've needed to go into a rental, situation. So it's actually strengthened our position in a number of ways, and now has us positioned to do much more in way of acquisitions, as a lot of these properties or submarkets have found their bottom, and they're really poised for some rampant growth over the next few years. It's really put us in a strong position for making further acquisitions.
So sharp investors will say that private investments are have more abilities to make more money, and you can make more money in private investment and rather than public investment like stock market and those things. Would you agree with that?
Yeah, as with any generalization, there's examples to the contrary. But in general, these types of investments are only available through private placement, as a private security. And it provides much more flexibility than with a public offering for the individual investor to make much higher returns. As a general rule, there's higher returns to be made in this type of an investment vehicle than in publicly traded securities. Yeah.
So you've made a purchase of a 97-unit apartment in 2011, and there was you got an amazing cash-on-cash return out of this. Can you elaborate a little bit more on that?
Yeah, there were a number of reasons for this on that particular property. Not only have we seen a very strong cash-on-cash return on that property, but we've seen forced appreciation of over 150% in the approximately 15 or 16 months that we've owned it. And there's several reasons for that. One of the reasons was that property was operating under a HUD contract that dictated certain aspects of how the property needed to be run. And one of the most significant of those really had the effect of rent control on the property. So the rents on each one of the units was way below market, in most cases $200 or $250 below market.
$200 times 97 units, that's quite a lot.
It adds up quickly, yeah, exactly. And a number of other things on that property where we could do specifically targeted capital investments to improve the appeal of the property to prospective tenants and really increase the rents significantly because of the increasing desirability of the property. So with a few of these changes that we made, including taking it out from under needing to operate under that HAP contract and being able to operate just within the confines of the marketplace itself, we were able to dramatically increase the cash flow and therefore dramatically increase the value of the property in a very short period of time. And the same kind of thing is available on many properties of many sizes, many submarkets. And like I mentioned a minute ago, really there's tons of these opportunities throughout the U.S. now that have been created through the contraction that we've seen over the last few years.
So can you forced appreciation is pretty much what you've done, and there's the other concept of natural appreciation. Can you explain a little bit more to our viewers the difference between forced appreciation and natural appreciation?
Sure. We really try to get the best of both worlds for our investors. Forced appreciation is where, like we talked about with the 97 unit, where there's a number of things that can be changed, usually simple things that can be changed about the operation of the property, not the least of which is putting in high quality institutional level management on the property that typically drives the costs down quite substantially. And on the 97 unit, we've seen our operating costs on there drop more than 50%. So that's hugely beneficial with regard, obviously, to cash flow and appreciation. So by making these simple changes, actually causing the appreciation of the property through having made the changes, that's forced appreciation. Whereas when you're investing in a particular market, let's say, the Raleigh-Durham MSA, that particular market is going to grow at some percentage over time. That's your natural appreciation.
Yeah, say 5%. And
yeah,
then
exactly.
when you combine both together, then you have much more.
Right. So we really try to couple them as well as possible. Again, making good decisions with regard to new investments from the standpoint of being able to force some appreciation, but also being in very strong MSAs where we expect there to be a fair amount of natural appreciation, and you put the two together and it can be very explosive growth. Yeah.
So in the 97 unit, I believe that, if I understand right here, you're working on the refinancing of that to recapture a good part of your initial investment, and also beyond that, so that you actually can reinvest part of this equity into other investment.
Yeah.
Is that correct?
Yeah, and this kind of thing in these types of private placement investments is frequently possible, not always, but we find ourselves with conditions very favorable for it right now, with the types of commercial loans that are available with very low interest rates for long terms, fully amortizing loans, very favorable terms on these loans, and a great time for us to harvest equity in assets like that one that we've been discussing. So we've had a tremendous amount of equity growth there. We've got equity in the property of several $1,000,000, and this is a great way to tap it by putting this high quality long-term financing on the property. Take some of that equity and invest it in other investments where we can re-leverage those equity dollars to bring higher returns to the investor.
Which is a little bit in line with what we talked about and together yesterday regarding a return on equity. That's to maximize those things, which probably will be a good subject for a future interview probably. And the fact that you're not selling the property, it's just taking a loan, so you're not actually, it's a non-taxable event. You're just refinancing and getting more money out of this, but it's just a loan, so no tax.
Exactly. So that really allows us to compound that effect of the growth even more than if the reverse were the case, where this was a taxable event.
Can you do? Do you think we can do that with stocks? Huh?
Yeah, we don't typically see any opportunity for this kind of thing in stocks.
Limited.
And obviously, it's one of the big differentiating factors between public securities or stocks and private securities such as this.
They're much more passive investment.
That's right. Yeah.
So I understand you recently completed the purchase and acquisition of another apartment complex. Can you tell a little bit more about this one?
Yeah, we recently had another opportunity come along, much like the 97 unit that we've been talking about, on an apartment complex that had many of the same opportunities available there for improvement, for very rapid improvement of the financial performance. It's located in our state capital in Montana, Helena, and in a great location right down near the heart of the business district. We're really excited about the opportunity, and we're just getting rolling with these repositioning activities right now, the same types of repositioning activities that we talked about with the 97 unit. So we expect over the next few months to see some dramatic results from that.
Good. So you're here with us in Raleigh for the past few days, and we're actually, when we intend to invest in a new market, we need to establish relationship with property management company and real estate brokers, and to basically build up our team. And so can you elaborate a little bit more on the need for that?
Sure. We see that as critically important for us to be able to make good investments and be able to cause those investments to perform in the way that we've projected. And as an example, with the Raleigh-Durham MSA, we're coming into the Raleigh-Durham MSA not having decades of experience here and not knowing the market the same way that a property management company that has 50 or 75 years of experience knows this market. And interestingly, in talking to those kinds of property managers, you find that they've typically managed whatever the target property is at different points over either the recent past or the distant past, and they know a lot about the individual properties. They know virtually everything there is to know about the submarket, and so by having strong relationships there, we can go into these investments with our eyes wide open and not have any surprises down the road, and we definitely want to avoid those surprises.
Mostly in the due diligence process as well as after the acquisition, yeah.
Absolutely, and many of these property management companies can do a large amount of the due diligence process for us. Yeah. So even from a physical condition standpoint, can give us excellent reporting with regard to exactly what we're looking at on a particular asset before we actually close on that asset. So can be invaluable. And then on the broker side, our deep and strong broker relationships help us to participate in investments that otherwise wouldn't be available to us. So also critically important.
So how would you say that this has been going so far, this relationship build-up?
Oh, I think it's been going fantastically well. We've been at it for the better part of a week here. I've met with a large number of brokers and have a number of broker meetings coming up here in the next few days. Have done the same thing on the property management side. And we're feeling very good about our ability to come into this MSA and make some great investments over the next 6 to 12 months. So
it's clearly
we're very
expertise.
excited. Yeah.
Good. Wonderful. So thank you very much for your questions and for your time. And so we hope that we'll be able to see you more in person, and keep us in touch with us so that you can learn a little bit more about us.
Thank you, Phil. It's been my pleasure.